Johan here. What I'm about to reveal in the next several minutes is going to completely flip the narrative you've been hearing about the silver crash. While everyone else is panicking, while retail traders are capitulating, while the mainstream media is writing obituaries for the silver bull market, something absolutely extraordinary is happening behind the scenes. And if you understand what I'm about to show you, if you can see through the noise to the actual positioning of the smart money, you're going to realize that we might be staring at the most explosive setup in the silver market in over a decade. Before we dive into the leaked information and the data that's surfacing from institutional sources, I need to know where you stand right now. Drop a comment. Write capitulated if you sold during the crash. Write holding if you kept your positions through the chaos. Write buying if you're accumulating at these levels. Or just write Johan if you're here to understand what's really happening. Because what I'm seeing in the data, what's leaking out of institutional trading desks, suggests that the narrative is about to shift violently. And the people who understand this shift early are going to be positioned for massive gains. Let me show you exactly what's going on. Let's start with what just happened, because we need context before we get to the leaked information. Silver crashed 33% in a single session last week, from $121 to $81. It was the worst one-day decline in over 4 decades. The mainstream explanation was that it was profit-taking, that the rally had gone too far too fast, that leveraged longs were getting flushed out. Standard bear market rhetoric. But here's what nobody's talking about. In the 72 hours since that crash, something has fundamentally changed in the positioning of the largest players in the silver market. The same institutions that were aggressively short, the same banks that engineered the takedown, are now quietly flipping their positions. And the evidence is starting to leak out through trading desk chatter, regulatory filings, and unusual options activity that's showing up in the data. I've spent the last 3 days talking to sources who work at bullion banks, hedge funds, and commodity trading firms. And the picture that's emerging is absolutely stunning. The crash wasn't the end of the silver bull market. It was a manufactured reset designed to allow institutions to flip from short to long at the most favorable prices possible. Let me walk you through exactly what's happening. First, let's talk about the JPMorgan leak, because this is the headline that should be dominating financial news, but isn't it? According to sources with direct knowledge of JPMorgan's precious metals trading desk, the bank has been aggressively covering short positions and going long silver since the crash to 81. Now, I need to be very clear here. I don't have internal JPMorgan documents. I'm not claiming to have emails or recordings. What I have is information from multiple independent sources who work in the institutional commodity space, people who see order flow, people who talk to the traders making these decisions, and people who have access to positioning data that isn't public yet. And all of them are saying the same thing. JPMorgan covered a massive portion of their short position during the crash and is now net long silver for the first time in years. Let me explain why this is seismic. JPMorgan has been the single largest short seller of silver in the futures market for over a decade. According to CFTC data and estimates from precious metals analysts, JPMorgan has typically held short positions ranging from 100 to 200 million ounces. They've used those shorts to suppress price, to manage their physical inventory positions, and to profit from periodic takedowns. But if the leaked information is accurate, if JPMorgan has flipped from short to long, that means they're now positioned to benefit from higher prices. And when the largest player in the market flips sides, you pay attention. Now, you might be asking, Johan, how would JPMorgan cover that much short exposure without driving the price up? That's a great question, and the answer is actually brilliant from a trading perspective, even if it's morally questionable. Here's what appears to have happened based on the order flow data. In the days leading up to the crash, JPMorgan and other bullion banks accumulated massive new short positions. They sold huge quantities of futures contracts during low liquidity hours, driving the price down from 121 toward 81. That crash triggered stop losses, margin calls, and forced liquidations from leveraged long positions. Once the selling cascade was in full effect and price hit the low around 81, the banks then stepped in as buyers. They covered their old short positions and even went net long, but they did it at prices $40 lower than where they started. So they engineered the crash to create the liquidity they needed to flip their positioning without paying higher prices. It's market manipulation on a grand scale, but it's also tactically brilliant if you're a ruthless institutional trader with deep pockets and no ethical constraints. The crash wasn't organic. It was a planned operation to reset positioning. And now that the reset is complete, the same institutions that drove it down are positioned to drive it back up. Let me show you the evidence that's surfacing to support this thesis, because I'm not asking you to just take my word for it. First, look at the options market. In the 3 trading days following the crash, open interest in silver call options has surged by over 30,000 contracts. Call options give the buyer the right to purchase silver at a specific price. You buy calls when you're bullish. The most popular strikes being accumulated are the $95, $100, and $110 calls expiring in the next 60 to 90 days. Someone is betting big money that silver is going to recover well above current levels within the next few months. And the size of the positioning, we're talking tens of thousands of contracts, suggests institutional players, not retail. Retail doesn't have the capital to deploy on that scale. This is hedge funds and banks positioning for a move higher. Second, look at the commitment of traders' data. Now, the most recent QOT report is from last Tuesday, so it doesn't fully capture the post-crash positioning yet. But the preliminary data that's leaking from sources who track this closely suggests that commercial short positions, that's the banks, have decreased dramatically. One source estimated that commercial shorts dropped by over 100 million ounces in the last week. That's a massive reduction. If banks are covering shorts, they're buying futures to close those positions. That's bullish. And if they're flipping to long, that means they're now incentivized to push prices higher to profit on the other side. Third, and this is fascinating, look at what's happening in the physical market. If institutions truly believed silver was going to continue crashing, if they thought 81 was just the beginning of a broader collapse, you would expect them to be liquidating physical holdings. But the opposite is happening. According to the COMEX depository data, registered silver inventory has dropped by another 9.4 million ounces since the crash. 9.4 million ounces withdrawn from the warehouses that are supposed to back the futures contracts. That's not bearish behavior. That's people pulling physical metal out of the system because they don't trust it or because they want to hold the metal directly in anticipation of higher prices. And here's the kicker. According to contacts at bullion dealers, institutional buyers, we're talking hedge funds, family offices, and commodity funds, have been aggressively buying physical silver bars in large quantities since the crash. One dealer told me they sold over 3 million ounces to institutional clients in the last 4 days. That's not retail buying 1-ounce coins. That's serious money accumulating tonnage. Why would institutions be buying physical if they thought the crash was justified and prices were going lower? They wouldn't. They're buying because they recognize the crash was artificial and the setup is now incredibly bullish. Now let me get to the really explosive part, the leaked price target. According to a source who claims to have seen internal JPMorgan research distributed to select clients, the bank's commodity desk is projecting that silver could hit $135 per ounce within the next 2 to 3 weeks. 135? That's a 67% gain from current levels around 81. Now, I need to be extremely clear about the sourcing here because I don't want to misrepresent anything. I have not personally seen this JPMorgan research document. I was told about it by someone who says they saw it. I cannot independently verify its authenticity. It could be real, it could be exaggerated, it could be completely fabricated. I'm telling you what I've heard. You need to apply your own judgment about credibility. But here's why I'm giving it airtime, despite the uncertainty. The price target aligns with what the technical analysis is showing. It aligns with what the physical supply and demand fundamentals suggest. And it aligns with the unusual options positioning and the reduction in commercial shorts. So even if the specific JPMorgan document doesn't exist, the target itself is plausible based on multiple independent data points. Let me walk you through why 135 is not some random moon boy number, but actually has technical and fundamental backing. First, let's look at the technical picture. Silver crashed from 121 to 81. That's a 33% decline. The low of 81 touched a critical support level. Specifically, it hit the 200-day moving average, which is currently at $79. The 200-day moving average is one of the most watched technical indicators by institutional traders. It represents the average closing price over the last 200 trading days, and it often acts as major support or resistance. Silver tagged that level and immediately bounced. We're currently trading around 92, which means we've already recovered $11 from the low. That's a 13.6% bounce in less than a week. If you look at the structure of the bounce, it's forming what technical analysts call a V-shaped recovery. That's when price crashes hard, finds a bottom, and then reverses sharply. V-shaped recoveries typically happen when the selling was not fundamentally justified, and buyers recognize value at lower levels. If this pattern continues, the next major resistance level is at 105, which is the 50-day moving average. If silver clears 105, the next resistance is at 115, which is the previous consolidation zone before the crash. And if it breaks 115, there's not much resistance until you get back to the old highs around 121. But here's where it gets interesting. If the fundamental drivers that took silver from $30 to $121 over the last year are still intact, and I'll argue in a minute that they are then breaking through 121, could trigger a momentum surge that takes silver to new all-time highs. The all-time high in nominal terms is around $50 from 1980. But adjusted for inflation, that's over $140 in today's money. So 135 isn't some ridiculous outlier. It's actually just shy of the inflation-adjusted all-time high. From a technical perspective, if silver breaks 121, 135 to 140 becomes a logical target. Now let's talk about the fundamental drivers, because this is what really matters long-term. The reason silver ran from $30 to $121 over the last year was not speculation or hype. It was driven by structural supply and demand imbalances that haven't changed just because the paper price crashed. Let's go through them. First, industrial demand. Silver is critical for solar panels, electric vehicles, 5G infrastructure, AI data centers, and military applications. Global solar panel production is at all-time highs and accelerating. Every panel requires about 28 grams of silver. Global EV production is growing despite short-term fluctuations. Every EV uses significantly more silver than traditional combustion engine vehicles. The expansion of 5G networks requires massive amounts of silver for the infrastructure. AI data centers are being built globally, and they require silver-intensive server components. None of this demand has disappeared because of a paper price crash on COMEX. Chinese solar manufacturers didn't stop their production lines. Tesla didn't cancel their vehicle orders. The data centers being built by Microsoft and Google didn't get shut down. Industrial demand is still there, and it's still growing. Second, supply constraints. Global silver mine production has been essentially flat for years. Most silver comes as a byproduct of copper, lead, and zinc mining, which means supply is tied to the economics of those base metals, not silver price. Even with silver at 121, you weren't seeing a massive surge in new silver mining projects because it takes years to bring new mines online. And with silver at 81, there's even less incentive. So supply is constrained and inelastic. Third, investment demand. Central banks have been buying gold at record pace to diversify away from the dollar. That same de-dollarization trend is starting to spill into silver. Retail investors globally are buying physical silver as a hedge against currency debasement and inflation. And now, based on what I'm seeing, institutional investors are joining them. Here's what makes the setup particularly explosive right now. The crash shook out weak hands. Leveraged traders who were long with too much margin got liquidated. Retail investors who bought near the top and didn't understand the fundamentals panicked and sold. But the strong hands, the institutions that understand the long-term thesis, the industrial users who need the physical metal, they didn't sell. In fact, they bought. So you have a market where supply is getting tighter, registered COMEX inventory is declining, industrial demand is robust, and institutional money is now positioned long after flipping from short. That's about as bullish a setup as you can get. The crash created the perfect launch pad, it cleared out the excess leverage, it reset sentiment to maximum pessimism, and it allowed smart money to accumulate at prices that won't be seen again if the fundamentals play out. This is what a capitulation bottom looks like. And if history is any guide, the move off a capitulation bottom is usually violent and catches everyone off guard. Now let me address the elephant in the room. Some of you are probably thinking, Johan, JPMorgan has manipulated this market for years. Why would I trust anything they're doing now? It's a valid question. JPMorgan paid $920 million in fines for spoofing precious metals markets. They've been caught manipulating gold and silver repeatedly. They're not the good guys. But here's the thing. You don't have to trust their motives to profit from understanding their positioning. If JPMorgan has flipped from short to long, that doesn't mean they suddenly became ethical. It means they see more profit potential on the long side than the short side. And when the biggest player in the market changes sides, price tends to follow because they have the capital and the market influence to move things in their favor. I'm not telling you to trust JPMorgan. I'm telling you to watch what they do, not what they say. And if the evidence suggests they've flipped bullish, that's information you can use to position yourself accordingly. The enemy of your enemy isn't necessarily your friend, but you can still profit from understanding the battlefield. Let me walk you through what I think happens over the next 2 to 4 weeks based on the data and the positioning. Week 1, we're in it now. Silver consolidates between 85 and 95. The initial bounce from 81 has brought us back to 92. We might see some back and fill as the market digests the move. Retail sentiment is still bearish. Mainstream media is still calling the crash the end of the silver rally. But quietly, institutional accumulation continues. Options positioning builds. Physical metal continues to be withdrawn from COMEX. Week 2, silver breaks through 95 and tests the 105 level. This is where sentiment starts to shift. People who sold at the lows start to feel regret. Traders who are waiting for lower prices realize the bottom is probably in. FOMO starts to creep in. If 105 breaks, we could see a rapid move to 115. Week 3, silver clears 115 and makes a run at the old highs around 121. This is where the short covering accelerates. Anyone who shorted near the lows is now underwater and scrambling to cover. The narrative in the financial media shifts from silver is dead to silver is back. Retail starts piling in again. Week 4, silver breaks through 121 and makes a run toward 130 to 140. This is where the melt-up happens. The combination of short covering, FOMO buying, and the realization that physical supply is critically tight creates a squeeze. Shanghai premiums widen further. Registered COMEX inventory drops below 100 million ounces, and the market starts to question whether COMEX can actually deliver physical metal to satisfy contracts. That's when things get really interesting. Now, is that scenario guaranteed? Absolutely not. Markets don't follow scripts. Unexpected events can derail any thesis. But based on the positioning, the technicals, and the fundamentals, that's the highest probability path I see. And if the leaked JPMorgan target of 135 is accurate, it aligns perfectly with that timeline. 2 to 3 weeks would put us in mid to late February. That's enough time for the consolidation, the breakout, and the momentum leg to play out. Of course, JPMorgan could be wrong, or the leak could be disinformation designed to lure retail into a trap. That's why you don't bet the farm on any single piece of information. You look at the weight of evidence across multiple data points. And right now, the weight of evidence is leaning bullish. Let me show you what to watch over the next several days, because these will be the signals that tell you whether this thesis is playing out or falling apart. First, watch the $95 level. If silver can break and hold above 95, that's a bullish signal. If it fails at 95 and drops back toward 85, that suggests more consolidation or even retesting the lows. Second, monitor the COMEX registered inventory. If it continues to decline, if we see another 5 to 10 million ounces leave the warehouses, that confirms physical tightness. If inventory stabilizes or increases, it suggests the shortage thesis might be overblown. Third, watch the Shanghai premium. Right now, Shanghai physical is trading about $30 over COMEX. If that premium stays elevated or widens, it confirms the paper price is disconnected from physical reality. If it compresses back to single digits, it suggests the physical market is less tight than we thought. Fourth, track the options open interest. If call open interest continues to build, especially in the near-term expirations, it confirms institutions are positioning for upside. If call interest drops or put interest surges, it suggests smart money is hedging for more downside. Fifth, pay attention to the mining stocks. Miners are a leading indicator for silver. If miners start outperforming silver, if they rally harder than the metal itself, that's institutional money telling you they're positioning for higher prices. If miners lag or decline while silver bounces, it suggests skepticism about the sustainability of the move. Now let me talk about the contrarian signals, because this is important. The crash created a level of bearish sentiment that we haven't seen in the silver market in years. Retail forums are filled with people saying silver is going to 50, it's going to 30, the bull market is over. Mainstream analysts are publishing pieces about how the fundamentals have changed and silver is entering a multi-year bear market. Social media sentiment is overwhelmingly negative, and that's actually extremely bullish from a contrarian perspective. Markets don't bottom when everyone is bullish. They bottom when everyone has given up, when sentiment is at maximum pessimism, when people who held through the entire rally finally capitulate and sell at the worst possible time. That's when smart money steps in, and that's exactly what appears to be happening now. The crash created the capitulation. Retail sold, institutions bought. And now, as the market starts to recover, retail is going to be sitting on the sidelines watching in disbelief while institutional money rides the move back up. It's the classic wealth transfer from weak hands to strong hands. And if you understand the game, you position yourself with the strong hands, not the weak ones. Let me address the risk factors, because I'm not here to pump opium. There are legitimate scenarios where this thesis doesn't play out. First, global economic slowdown. If we enter a recession, if manufacturing activity collapses, industrial demand for silver could weaken enough to justify lower prices. I think this is unlikely given the structural trends in solar and EVs, but it's possible. Second, regulatory changes. The CFTC or the CME could impose new rules that change the dynamics of the market. Position limits, margin requirements, forced cash settlement, all of these could disrupt a potential squeeze. Third, massive new supply. If a major new silver discovery comes online, or if recycling dramatically increases, it could ease the physical tightness. Again, unlikely in the short term, but possible over longer timeframes. Fourth, dollar strength. If the dollar surges due to a global crisis, it would put pressure on all commodities, including silver, regardless of physical fundamentals. And fifth, the leak could be wrong or intentional disinformation. Maybe JPMorgan isn't actually long. Maybe the 135 target is fabricated to lure retail into a trap before another takedown. These are real risks, and they need to be acknowledged. That's why position sizing and risk management matter. You don't bet everything on one trade based on leaked information. You size your position appropriately, you set stops, and you manage risk. But here's why I'm leaning bullish despite those risks. The physical market is telling a very clear story. Shanghai premiums are elevated, COMEX inventory is declining, retail premiums are high, dealer supply is constrained. These are not abstract data points. These are real-world signals that physical metal is scarce. And in a commodity market, physical scarcity eventually wins. Paper markets can suppress prices for a while through manipulation and unlimited contract creation. But at some point, industrial users need actual metal. And when they can't get it at the paper price, they pay premiums. And those premiums eventually force the paper price to catch up to reality. And we're seeing that divergence right now. The question is how long it takes for convergence. My bet, based on the evidence, is that convergence happens sooner rather than later. And when it does, the move is going to be explosive because of all the shorts that need to cover and all the sidelined money that is going to FOMO back in. Let me tell you what I'm doing personally, and you can decide if it applies to your situation. I'm holding my physical silver. I didn't sell a single ounce during the crash, and I'm not selling now. I view physical as long-term insurance and a speculation on the failure of fiat currency systems. The paper price is irrelevant to that thesis. I'm watching the technical levels I mentioned, 95, 105, 115, as confirmation points for the bounce. I'm monitoring the data signals, inventory, premiums, options, COT, to validate the institutional positioning thesis. I'm staying in touch with dealers and sources to track what's happening in the physical market. And I'm prepared for volatility. If we get another flush down, I'll view it as a gift to add more. If we rip higher, I'll let my positions run and trail stops higher to protect profits. The key is having a plan, managing risk, and not letting emotions drive decisions. Fear and greed are the enemies. Data and discipline are your allies. 3 critical takeaways from this developing situation. 1. Institutional positioning appears to be shifting dramatically bullish following the crash. The reduction in commercial shorts, the surge in call option open interest, and the aggressive institutional buying of physical all suggest that smart money is positioning for significantly higher prices. Whether the specific JPMorgan leak is accurate or not, the circumstantial evidence points to a major flip in sentiment among the players who actually move markets. 2. The physical silver market is showing clear signs of tightness that contradict the bearish paper price action. COMEX inventory is declining, Shanghai premiums are elevated, retail premiums are high, and dealer supply is constrained. These physical market signals suggest the crash was artificial manipulation, not a fundamental repricing, and that physical scarcity will ultimately drive prices higher regardless of paper games. And 3, the technical setup following the crash is textbook capitulation bottom. Silver tagged the 200-day moving average, formed a V-shaped reversal, cleared initial resistance, and is now consolidating before the next leg. If the pattern continues, the move back toward 120 and potentially to new highs could happen faster than most people expect, especially if short covering accelerates. So where does this leave you right now? If you sold during the crash, don't beat yourself up, but recognize that you likely sold to institutions at the worst possible time. The question now is whether you get back in or sit on the sidelines. If you held through the crash, congratulations, you survived the shakeout. The question now is whether you add to positions or just hold what you have. If you're sitting in cash, you're facing a decision. Do you wait for confirmation and risk missing the move? Or do you position now while sentiment is still bearish and risk being early? There's no right answer that applies to everyone. It depends on your risk tolerance, your time horizon, and your conviction in the thesis. What I will say is this. The setup right now looks remarkably similar to other major bottoms I've studied in commodity markets. Crash, capitulation, institutional accumulation, consolidation, then explosion. We're in the consolidation phase. The explosion, if it comes, will catch most people off guard because they're still licking their wounds from the crash. The people who profit are the ones who can see through the fear to the opportunity. Are you one of them? Time will tell. Stay sharp, stay informed, and don't let the emotions of the crash cloud your judgment about what's happening now. Johan out.